Welcome to Potty, May 12, 2026. Here's the tension that's been sitting with me all week. Anthropic is reporting revenue numbers that would be extraordinary for a company that's been around for 20 years, let alone one that's barely 4 years old. We're talking about going from $1 billion in annual recurring revenue to nearly $30 billion in roughly 15 months. That is not a typo. 30-fold growth in 15 months. And yet, and this is the part that keeps me up at night, some of the most credible voices in tech journalism are simultaneously raising the question of whether any of this actually translates to profit. CNBC ran a headline that said AI demand is inflated, and that only Anthropic is being realistic about it. The Verge is warning that users are about to feel an AI money squeeze. So what's actually going on here? Is Anthropic the winner of the AI race, or are we watching one of the most expensive growth stories in tech history play out in real time? That's what we're getting into today. Let me set the stage, because to really understand what's happening with Anthropic, you need to understand what kind of company it actually is. And it's not what most people think. Anthropic was founded in 2021 by Dario and Daniela Amodei and a group of former OpenAI researchers. It's positioned as an AI safety company, which is part of its brand identity and its research mission. But from a business model perspective, Anthropic is fundamentally an AI infrastructure and platform company. It's not building consumer apps. It's not trying to be the next Google search. Its flagship model family, Claude, is sold primarily via API to enterprise and developer customers. Businesses plug into Anthropic's models through that API and pay for what they use. That distinction matters enormously for how you evaluate its financials. So, the pricing model is usage-based. Customers pay per token. And here's what most people get wrong about this. A token is not a word, but it's roughly close. It's the atomic unit of computation for large language models. When you send a message to Claude, that input text gets tokenized. When Claude responds, those output tokens are also billed. Customers are charged per million tokens processed. Now, why does this matter? Because it creates a completely different business dynamic than traditional software. In a SaaS subscription model, you sign a customer up for a flat fee and your revenue is predictable and largely decoupled from usage. In a token-based model, revenue scales directly with how much AI computation customers consume. More usage, more revenue. But, and this is the critical caveat, more usage also means more compute cost. Every token you generate requires GPU time, which is expensive. So the flywheel spins both ways. Now, let's talk about the actual numbers, because they are genuinely staggering. I was looking at data from Sakra and multiple other sources tracking Anthropic's ARR trajectory, and the ramp looks almost like a vertical line on a chart. January 2025, $1 billion in ARR, then $4 billion, then $9 billion by December 2025, then $19 to $20 billion in early 2026. And by April 2026, reports suggest Anthropic is approaching $30 billion ARR. One headline I came across framed it as, OpenAI won the headlines, Anthropic won the money. And honestly, that framing is doing a lot of work, because OpenAI has enormous consumer mindshare. ChatGPT is basically synonymous with AI for most people. But in the enterprise API segment, in the developer ecosystem, Anthropic appears to be running a very different and very successful race. The valuation story is equally wild. Anthropic recently closed, or was nearing the close of, a financing round that initially targeted around $10 billion. But investor demand came in multiple times larger than that initial target, and the round ballooned to over $20 billion at a pre-money valuation of $350 to $380 billion. Singapore's sovereign wealth fund, GIC, and Coatue Management were among the investors. So you have a company that went out looking for $10 billion, and the market basically said, here's 20, we want in. That is a signal. It's not proof of underlying profitability, but it is a signal that sophisticated institutional capital believes this trajectory is real. The question, and I want to keep coming back to this, is whether the revenue quality matches the revenue quantity. Let me explain what I mean by revenue quality, because this is where the story gets genuinely complicated. There's a piece I was looking at from CNBC. The headline is blunt. AI demand is inflated, and only Anthropic is being realistic. The core argument is that the main usage metric for AI, which is tokens, looks explosive on paper, but may be significantly overstated as a measure of real economic value. Think about what generates tokens in an enterprise context. You've got internal pilots that never reach production. You've got automated pipelines that loop. Systems that call the API repeatedly generate tokens and don't produce anything a human ever looks at. You've got agentic systems that consume enormous amounts of tokens as they reason through tasks, sometimes hallucinating their way down dead ends before recovering. All of that counts as token consumption. All of that shows up in ARR, but not all of it is creating business value for the customer. This is what economists would call the distinction between a leading indicator and a lagging indicator of value. Token consumption is a leading indicator. It tells you that people are using the product. But whether that usage translates into retained customers, renewed contracts, and expanded spend depends on whether those customers are getting ROI. And here's the uncomfortable truth. For a lot of enterprise AI deployments right now, the ROI calculation is genuinely murky. Companies are running experiments. They're building internal tools. They're trying to figure out where AI fits in their workflows. That exploratory phase generates a ton of tokens, and it generates revenue for Anthropic. But it doesn't necessarily mean those companies are locked in for the long term. They might consolidate. They might cut. And if a meaningful portion of Anthropic's ARR is sitting on that shaky foundation, then the 30 billion number looks very different. But here's where Claude Code changes the analysis in a really significant way. The headline I saw framed it directly. Anthropic ARR surges to 19 billion on Claude Code's strength. Claude Code is Anthropic's AI coding agent. It's not just a chatbot you ask programming questions. It's an agentic system that actually writes, edits, runs, and debugs code. And the reason this matters for the revenue quality question is that coding agents have a much cleaner ROI story than almost any other AI use case. When a developer or a company deploys Claude Code, and it writes working software, that software is a direct substitute for expensive human engineering labor. The value creation is measurable. You can count the lines of code, you can count the features shipped. You can compare the cost of Claude Code tokens to the cost of an engineer's time. That math, in many cases, works out clearly in favor of the AI. And that cleaner ROI story has a downstream effect on customer behavior that is strategically crucial. It makes retention stickier. When a company is using Claude for exploratory chat, it's relatively easy to switch to a competitor or cut the budget if things get tight. But when Claude Code is embedded in your engineering workflow, when your developers are relying on it daily to ship features, when your CI/CD pipeline is integrated with it, that's not a tool you rip out casually. That's infrastructure. And infrastructure spend is much more defensible than experimental spend. So the fact that Claude Code is being identified as a primary growth engine for Anthropic's ARR is not just a product story. It's a signal about the quality and durability of the revenue base. My read is that this is the single most important data point in this whole story. There's another layer to this that I find genuinely fascinating, which is the Anthropic Economic Index. Anthropic published a report in February 2026, tracking how Claude is being used across the broader economy. They're using privacy-preserving data analysis to understand the economic primitives of AI usage, what kinds of tasks people are doing, what industries, what functions. And the framing of this project is really telling. Anthropic isn't just saying, here's how people use our product. They're saying, we are trying to understand the macroeconomic impacts of AI as early as possible, so that researchers and policymakers have time to prepare. That is a company positioning itself as economic infrastructure, not as a software vendor. Whether or not you buy the altruistic framing, the strategic implication is clear. Anthropic wants to be the layer of the economy that serious AI activity runs through. That's an enormous ambition. And the ARR numbers suggest they're not entirely wrong to have it. Now, let me get into the cost side of this, because you cannot evaluate Anthropic's financial story without understanding how brutal the cost structure of frontier AI actually is. Running large language models at scale is expensive in a way that is genuinely hard to convey. The primary cost is GPU compute, specifically inference compute, which is the cost of running the model to generate responses. Training a frontier model like Claude costs hundreds of millions to billions of dollars in compute. But inference, the ongoing cost of serving every single API call, is a continuous per-token expense that scales directly with usage. Cloud hyperscalers running commodity workloads can achieve gross margins of 60 to 70% or higher. But frontier AI inference, especially for large, capable models, is compute-intensive enough that those margins compress significantly. One analysis I came across estimated that if Anthropic's ARR is at the lower end of the 30 billion range, the gross profit could be around $15 billion. And that number, 15 billion in gross profit, is actually significant. It covers a lot of training compute. It suggests a business that at scale could be structurally viable. But the critical word there is could. Whether those margins hold depends on a few things that are genuinely uncertain right now. First, whether Anthropic can continue improving model efficiency, making Claude faster and cheaper to run through inference optimization, distillation, and using smaller specialized models for routine tasks. Second, whether enterprise customers are actually in production with high-value use cases or still in exploratory phases. And third, how aggressive the competition gets on pricing. If OpenAI or Google decide to price aggressively to win market share, margins across the board compress. This is not a settled question. Let's talk about the competitive dynamics for a second, because this is where the story gets strategically interesting. There's this piece I was looking at that framed Anthropic's growth model as operating by different rules than traditional SaaS: usage-based pricing, developer-led growth, platform thinking. And the argument is that developer-led growth is particularly powerful because developers are the ones who decide what infrastructure a company uses. When developers fall in love with a tool, it gets embedded in production systems. It gets recommended in engineering communities. It spreads through organizations bottom up. That's how Stripe grew. That's how Twilio... And that's apparently how Anthropic is growing. Not through top-down enterprise sales, but through developers choosing Claude, building on it, and then the organization's spend following the usage. That's a very different, and arguably more defensible, go-to-market motion. So where does all of this leave us on the big question? Is Anthropic actually winning? My honest read is yes, in the specific market that matters most right now, which is enterprise API and developer infrastructure. OpenAI has dominant consumer mindshare with ChatGPT, and that is genuinely valuable. But mindshare doesn't automatically translate to enterprise API revenue. In the segment where serious software gets built, where companies are making multi-million-dollar token commitments, where coding agents are becoming workflow infrastructure, Anthropic appears to be holding a disproportionate position. The valuation, the ARR trajectory, the investor oversubscription. These are all market signals pointing in the same direction. But I want to be careful not to declare victory prematurely, because the skeptics are raising real concerns, and the profitability picture is genuinely complex. The Verge headline, "You're about to feel the AI money squeeze," is pointing at something real. The framing is that leading labs, including OpenAI and Anthropic, have raised billions from investors to fuel scaling and compute needs, and that users are going to feel the financial pressure of that. What I think this means practically is that the era of aggressively subsidized AI access, where you could run enormous workloads for surprisingly low prices because labs were prioritizing adoption over margin, may be ending, as Anthropic needs to demonstrate a path to profitability to justify its valuation. Pricing pressure to users could increase, and that's a real test of whether the use cases that enterprises have built are valuable enough to sustain higher costs. The ones built on Claude Code and measurable engineering output probably are. The ones built on exploratory chatting probably aren't. That's the bifurcation coming. Let me make a prediction here. And I want to be clear, this is pattern matching from the signals I'm seeing, not first principles research. But based on Claude Code's outsized contribution to ARR growth, based on the broader industry shift toward agentic AI systems that complete tasks rather than just respond to queries, and based on Anthropic's explicit focus on developer-led adoption, I think there's a plausible trajectory where coding and software engineering agents become the dominant revenue category for frontier AI labs by the end of 2026. Not chat! Not search! Not summarization. Code. And if that's right, Anthropic is currently holding a disproportionate share of the market that's going to matter most. The velocity of Claude Code adoption relative to chat-based usage suggests the market is already voting with its token spend. Watch where the tokens go. That's where the real money is. Here's the contrarian take that I think most people haven't fully considered. The bifurcation in enterprise AI spending that I mentioned earlier, where high ROI use cases grow and low ROI use cases get cut, might actually be good news for Anthropic specifically, even if it's bad news for the industry's aggregate token growth numbers. Here's why. If exploratory low-value token consumption collapses while agentic coding and workflow automation token consumption explodes, the headline number for industry-wide token growth might look like a deceleration. Analysts might write AI demand is cooling, but Anthropic, if it's disproportionately indexed to the high ROI use cases, could see its revenue continue climbing even as competitors struggle. That would actually validate the CNBC narrative that Anthropic is being realistic about demand quality, and accelerate its competitive separation from labs that are more dependent on diffuse, low ROI token consumption. The company that wins might not be the one with the most tokens. It might be the one with the best tokens. There's also a comparison floating around in the analyst community that I find both fascinating and slightly terrifying. The idea that Anthropic could surpass Alphabet's revenue trajectory by mid-2028. Alphabet, meaning Google, the company that generates roughly $300 billion in annual revenue. Now, I want to be very careful here. That projection implies a continuation of hypergrowth at a pace that very few companies in history have sustained, and it implies that the margin structure works out. That Anthropic can scale revenue faster than it scales compute costs. Those are enormous assumptions. But the reason analysts are even making this comparison is that the ARR trajectory, if extrapolated, is genuinely in that neighborhood of insanity. Whether it gets there depends on factors we can't fully model today. But the fact that it's a conversation worth having tells you something about the scale of what's happening. So let me bring this home. What do you actually understand now that you didn't at the start of this episode? Here's the arc. Anthropic has achieved one of the fastest revenue ramp-ups in enterprise software history, driven primarily by a usage-based, token-priced API model, and increasingly by Claude Code as a coding agent. The revenue is real. The growth is real. The investor conviction is real. $20 billion raised at a nearly $400 billion valuation doesn't happen by accident. But the profitability picture is genuinely unresolved, and the skeptics raising questions about token quality and cost structure are not wrong to ask those questions. The key variable, the one I'd be watching most closely, is whether agentic task completing use cases like coding agents continue to dominate Anthropic's token consumption mix. If they do, the revenue is more defensible, the margins are more sustainable, and the growth story has legs. If the mix shifts back toward exploratory low ROI usage, the whole thing looks much shakier. If you want to dig deeper into this, I'd point you toward a few things. First, track the Anthropic Economic Index as they release new reports. It's genuinely interesting primary source data on how Claude is actually being used across the economy, and it will tell you a lot about whether the usage mix is shifting toward high-value or low-value applications. Second, watch the pricing moves. If Anthropic starts raising API prices in 2026, that's a signal they're confident enough in customer lock-in to test margin expansion. If they hold or cut prices, They're still in the land grab phase. Third, pay attention to how enterprise customers talk about Claude Code in their own earnings calls and developer blogs. The bottom-up signal from engineering teams is more reliable than any top-down analyst projection. The companies that are shipping faster because of Claude Code will say so. And that's the signal that matters. The headline that keeps coming back to me is the one that said OpenAI won the headlines, Anthropic won the money. And I think that framing is going to age really well or really badly, depending on what happens in the next 18 months. If agentic AI coding becomes the defining enterprise use case of this era, and if Anthropic has genuinely built the best product and the stickiest developer ecosystem for that use case, then we're going to look back at 2025 and 2026 as the moment when the outcome of the AI infrastructure race was quietly decided, while everyone was still debating which chatbot gave better answers. The race wasn't won in the consumer app. It was won in the API. It was won token by token, in the code that companies were quietly shipping with AI assistance. And if that's true, the most important AI company of the next decade might not be the one with the most famous name. It might be the one with the most indispensable infrastructure. That's the bet Anthropic is making. And right now, the market is saying that bet looks pretty good.